You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Mat Cashman, a 20-year options veteran with roles ranging from market maker and risk manager, among others, and now, lucky for us, a fellow options instructor here at OIC. Matt, welcome back.
Thanks, Mark. I'm happy to be here and excited to talk about options.
Well, I'm very glad to hear that, Matt, because I was looking over OIC's website the other day, and I noticed that you're going to be presenting two upcoming webinars on the Greeks, including a session where you're going to be talking about what we refer to as second-order Greeks, which I'll admit I'm not very familiar with, nor are many of our listeners, I'm guessing. So with that in mind, I was hoping to have a discussion on the Greeks where we could begin with those that most of us are familiar with, namely delta, gamma, theta, vega, and rho, and then have an overview on some of those lesser-known second-order indicators. How does that sound?
That sounds great. Hopefully we can start with the basics and shed a little bit of light onto the maybe slightly lesser-known second-order Greeks at the end.
Right, exactly, and that's the intention. So with that in mind, let's go ahead and, as you mentioned, let's start with those more frequently or more well-known Greeks and what they tell us collectively. So to begin with, I usually refer to the Greeks as theoretical pricing concepts that help investors forecast options pricing changes based on market movement. But that's not entirely accurate, is it?
I think it's pretty accurate. I mean, that's one way to think about it, certainly. I like to think about it in a slightly different way. And most of the time, each one of us that are options industry council instructors here teach it in a slightly different way. The way I teach it and the way I think about it is that Greeks are really a way for you to take a quick look at your position and look at the headline risks that you have on. So in a sense, they're like a dashboard. They're like a dashboard for a car, for instance, that you're driving. You don't necessarily need to, if you're driving down the road, stop the car and open the hood to look to see whether or not the engine is running, because your tachometer tells you that the engine is running. It gives you the revolutions per minute of your engine. You don't need to understand how fast you're going from any other way other than looking down at your speedometer. It tells you how fast you're going. And so Greeks, from my perspective, are a good way for people to understand what their risks are for their options position, even if it's just one option, that you need to understand how that option might change over time or based on other changing factors in the marketplace, and they help you to get a better handle and have a mental framework around what your risk is for that option position. Now, those Greeks can extend from the beginning to the very end of how complicated you want to look at what your mathematical risks are, but really what they are is a combination of all of those things to be able to understand how much risk you have on and where that risk is and how sensitive it is to movement in different dynamic parts of the marketplace.
Well, I love the analogy that you used about the dashboard, that taking a look at the Greeks, for example, can tell you how fast your position is going. That tachometer analogy that you used. So I love that analogy that looking at the Greeks can help you understand what might be on the horizon. Pricing wise for your contract. So great analogy, great clarification. Thank you. I certainly like your version better than mine. So let's go ahead and get started with the Greek that most investors are familiar with, at least my assumption that they're most familiar with. And for me, the one that I think makes the most sense. So let's go ahead and start out with Delta. What is it and what does it tell us?
Yeah, absolutely. Let's start at the beginning. Delta. The technical definition of delta is the amount of change of an option, the amount of change of the option's price based on a $1 move in the underlying instrument, whether that be a stock, a bond, a commodity, or what have you. Delta of an option is really how much you can expect that option from a theoretical standpoint, from your theoretical model's perspective, to move in its valuation based on a $1 move up or down in the underlying. Now, there's three real ways that people generally think about delta. The first is that, which is what I said. That's its real kind of mathematical definition as far as delta is concerned.
Right, and what you're talking about, the rate of change or how that option is going to value is going to change in relation to the underlying stock. You're talking about the sensitivity, right? How sensitive is that option going to be to pricing changes in the underlying stock, right?
Yes, absolutely. So that's one way that people think about it. Now, another way that people use that Greek is, and this is generally used if you're a market maker and you're thinking about how to hedge your risk when you're trading options, either buying or selling options. The first thing that I would think about when I was a market maker is, what is the delta of this option after I traded it? And the reason why is because I need to know how much of the underlying instrument I need to hold against this option in order for my delta risk to be neutralized. So people who are market makers generally use delta as a way to understand how much they should be hedging, how they should hedge this option. Because technically, most of the time, when you're a market maker, you're buying or selling options, but then you're making a stock trade that is a counteracting trade risk-wise that actually hedges your exposure. And so delta in that regard, people generally use as a way to measure how much they should hedge as far as the underlying instrument is concerned. There's a third way that people really think about delta, and this is something that I think is more pertinent for maybe the beginner options trader to think about it in these terms. And that is, delta can sometimes be considered as the marketplace's best guess as to the probability of that option finishing in the money. With that said, you can think about maybe a 70 delta option that you're trading. If it's a 70 delta call, it has a 70 positive delta, but it also has, theoretically, if you think about it in this framework, a 70% chance of finishing in the money as it has been kind of crowdsourced. Its value is really based on the idea of the marketplace's best forecast as to what its probability is of finishing in the money. So that's a third way that people like to think about it sometimes. Like I said, when we teach all of these concepts, we try to teach them in different ways and allow people to kind of mentally latch on to the one that best fits the way that their brain works, because options can be kind of complicated in that way. And there's 3 different ways that you can kind of think about delta.
Okay, excellent. So to recap, what you told us is that there are basically 3 definitions or 3 uses of delta, one of which being the sensitivity of that option to a $1 move in the underlying stock. It can also be used as a measure of risk to hedge a trade or to hedge a portfolio, and it can also be used as a measure to tell us the probability of that option finishing in the money. So those would be the 3 definitions. Okay, excellent. I love that. Thank you. Very clear, very concise. Now let's get to the kind of cousin of delta, if you will, and that would be gamma. What does gamma tell us?
So gamma is technically the first derivative of delta. And what that means from our perspective for this conversation is that gamma, its technical definition is it's the sensitivity of an option's delta to a 1-point change in the underlying. So while you look at delta and you think about how it affects the value of the option itself for a $1 move in the underlying, gamma is the actual sensitivity of, for that same $1 move, how much theoretically is your delta going to move? Not how much is the value of the option necessarily going to move, but how much is the delta of the option going to move? Now, the interesting thing about gamma is that it's always expressed as a positive number for the option itself. Now, when I say that, when I teach this concept, I inevitably get the question that people ask, which is, well, I always hear commentators talking about negative gamma positions that the dealers have and things like that. So how is it possible that gamma can be negative? You're telling me that gamma is always positive. What I'm telling you is that gamma itself for the option is positive, because gamma is a measure of kind of potential energy within the option. If you think about it in the terms of, it is a measure of how much the delta could move based on a $1 move, you're talking about the net positive potential change in this option, in its delta. And so because of that, mathematically, it's expressed as a positive number. Now, what you need to think about as far as your trading is concerned is that you can create a negative gamma position by doing something with that option. The option itself has a positive gamma metric, but if all you do is sell options to someone else, what you are doing is creating a negative gamma position. And the converse is also true. If all you do is buy options from someone, you are creating a positive gamma position. The gamma of the option itself is always expressed as a positive number. It is what you do with that option that can create either a negative or a positive gamma position. Now, one thing that people think about in terms of gamma is they think about it, if we go back to that original idea that I had about it being a dashboard, all these Greeks being a dashboard, people like to think about gamma as acceleration instead of speed. People oftentimes like to make the analogy that delta is kind of like speed as far as when you're moving in your car. Gamma is the concept of acceleration. I personally like to think about gamma as potential energy, as the potential of the option to change in delta. And so when you're thinking about gamma, and it is the actual it is technically a second derivative. It's the first derivative of delta, but you need to think about gamma as gamma changes your delta, and delta changes the valuation of the option itself.
Okay, excellent. I love the speed versus acceleration, and I love the definition or the analogy that gamma is the energy in the option that propels that delta forward. All excellent points, and definitely great things. Great information to give our listeners something to think about. You were talking about negative gamma, and that kind of reminds me a little bit of the next Greek that we're going to be talking about, theta. To me, theta or time decay is always negative. It's always eating away at the option. But some people talk about positive theta, and some people talk about negative theta, kind of the same way that you were talking about gamma, that gamma is always positive. But there are ways to make it negative. So let's go ahead and transition over to theta and talk about that time decay and how that works against buyers and works for sellers. So tell us about theta, if you would.
Yeah, absolutely. And I really like that idea also. When you tie together those two concepts, right? Gamma is expressed as a positive number, but you can have positive and negative gamma depending on what you do with the option. Theta is the same way. Theta is expressed as a negative number generally because of the fact that it's always coming out theoretically of options. But you can create a positive or a negative theta position based on what you do with the option, either buying or selling it. Theta's definition is it is the theoretical amount that that option should decay over a 24-hour period of time. So theoretically, if you've got an option worth $2 on your sheet and it has 8 cents of theta, and you fast forward your clock one full day, 24 hours to exactly this time tomorrow, your option model probably is going to tell you that that option should be worth at that point in time $1.92, because 8 cents of theta equates to 8 cents of valuation that come out of that option over a 24-hour period of time.
And of course, we're assuming that all other factors are held constant. Stock price Absolutely. Is the same, implied volatility is the same, et cetera.
Yeah, absolutely. And that I think is a really important concept, because when you're talking about Greeks, we're not going to get into this today, but when you're talking about Greeks, they're all interrelated as well, right? They have power over each other, and it's important to understand as your knowledge base grows, you'll start to understand how they affect each other. But when we're talking about them as just concepts, as just mental frameworks, what we're really trying to drive the point home is that if you keep everything else constant and you just fast forward 24 hours, what your option is going to theoretically change in value should be theoretically by your model its theta amount. And that's
right. We're taking a snapshot of a certain period of time, and all of the inputs are fixed, and then comparing that to another snapshot, say the next day, where the only input that changed was that time being taken off the calendar, as you mentioned.
Yes, absolutely. And to speak to your point, when you first had this question, theta generally, because it is a decay function, meaning that it is working negatively against the actual value of the option, will work positively for the sellers of options and negatively for the buyers of options. It's instructive in the way that people think about how a long position versus a short position works as far as options are concerned. Because if you're long options, theta is working against you constantly. And if you're short options, it's on your side constantly as those options decay over that 24-hour period of time, theoretically.
Right. And, what I like to, when I'm talking about the Greeks, what I like to tell people about theta is that, that time value of the option, that extrinsic value of an option contract, of the options premium, is a period of time, whether it's 2 days, 2 weeks, or 2 years, for something to happen with that contract, for there to be stock price movement, for there to be changes in implied volatility, et cetera. So the longer time frame there is, look at it from a seller's perspective, the longer time frame there is, the more chances are for something to go wrong, and that seller is accepting more risk. And it's, one of the things, as we all know, it's why a longer term option costs more than a short term option. Time is money, that old adage. But as that time shrinks, there are less opportunities for that stock price to move. There are less opportunities for implied volatility to change. And therefore, because there's less opportunity, there's less value. And that value, that decaying value, that shrinking value, is the time decay that you're talking about, and that's derived from theta.
Yeah, absolutely. And I think it's important to think theoretically about theta. It affects the options value holistically, right, over time. But generally speaking, what you're really decaying over time is that extrinsic value. The intrinsic value of an option, meaning the difference between its strike price and where the underlying is trading, that portion of the options valuation doesn't decay as quickly as the extrinsic value does. And so when we're thinking about theta, I want you to kind of concentrate that idea surrounding the extrinsic value of the option, because that's really where the majority of that theta is going.
Excellent. Thank you. Next up, Vega. What can you tell us about Vega?
Vega, the all-important Vega. Vega is the measurement of how much an option's value will change based on a 1-point move or a 1 percentage point move in implied volatility. So, just like an option's delta will change or theoretically will change with a $1 move in the underlying, Vega is the measure of how much the option's valuation moves if you move vol, or implied volatility, up or down 1%. Vega is expressed as a positive number. And what it really measures is how much the option's going to move if you move vol, let's say from 20, right? Let's say the implied volatility of the option you bought is 20. And the option has 12 cents of Vega in it. If you were to move that implied vol from 20 up to 21, keep in mind implied volatility is a dynamic force that moves all the time, and you were to keep everything else constant, the value of that option that had a 12 Vega, or 12 cents of Vega, oftentimes expressed as a decimal, 0.12 in this case, would move up. If you were moving vol from 20 up to 21, would theoretically move up by 12 cents. And so Vega is really just how much the option is going to move based on a 1-point move in implied volatility. The interesting thing about Vega, and the thing that you need to really keep in mind, especially if you're trading long-term options versus short-term options, is that the concept of time that we just used to explain theta really exists within Vega as well. And because of the fact that Vega is the sensitivity of an option to an implied volatility move, options that have longer duration or more time to expiration are going to have more Vega in them. They are going to be more sensitive to implied volatility moves than shorter term options are. We have a lot of people that have moved from trading 30-day options to trading 0-day options or 5-day options. And what you really need to keep in mind is that as you move your options around on that duration curve, each one of those options, based on its days to expiration, is going to have a different sensitivity to implied volatility moves. It's going to have a different Vega. And so that's really where that risk is concentrated for Vega is concerned. And always remember, if you're trading longer term options, those options have more Vega in them than shorter term options do, meaning they're going to be more sensitive to movement in implied volatility.
Okay, great. And we're running out of time here, but let's stick with the short term versus long term. And let's talk about ROE, sensitivity to interest rates. What can you tell us about that quickly before we close up with talk about second order Greeks?
Yeah, absolutely. So really quickly, ROE is something that we haven't talked about for a really long time because interest rates have essentially been zero for a very long time. We've been in a zero interest rate policy environment. ROE is an option sensitivity to movement in the risk-free rate. And so rho is going to change an options valuation when you move the risk-free rate up or down. There's kind of a joke in the options world that rho hasn't really been useful for the last 10 years because interest rates haven't moved. Well, over the last 12 months, we've seen interest rates go from 0 up to over 4% based on the FOMC movement. And so rho is a lot more important now than it used to be. What we like to talk about is that rho is something that's going to affect an option based on how big that option is in notional value. That's the way I think about it. Because you're trading options and tying up what I consider to be like a block of capital over a period of time based on the options premium, rho is going to be more sensitive in options that are larger, generally speaking, because the premium that you have to tie up in order to trade them is a larger block of capital. And if you think about rho actually is based on interest rates. If you were to consider having $250,000 in the bank versus $250 million in the bank, and someone changed your interest rate from 0 to 4%, it would make a bigger difference on a bank account with $250 million in it than it would with $250,000. That's kind of the same concept of rho. It's going to affect larger options more. And so those longer term options or options that are deep in the money and have large premium amounts associated with them have more rho than other options.
Okay, excellent. Thank you so much. We've got just a couple minutes left, so I want you to, if you could, please give us a quick overview of these second order Greeks and what we talk about when we refer to second order Greeks. But I do want to mention that you do have some upcoming webinars in March that will not only break down the concepts that we talked about today, delta, gamma, theta, vega, and rho, but you're also going to be dedicating a big part of that to the second order Greeks. So whatever we don't get to today, due to our time constraints, unfortunately, I want to make sure that the listeners tune in to your upcoming webinars to get a deeper dive into second order Greeks. So with that, Matt, we've got about just another couple minutes. What can you tell us about second order Greeks in the next, say, 60 seconds?
Oh, yeah, I like it. Second order Greeks in 1 minute or less.
Lightning round.
Not a lightning round. Technically, gamma is a second order Greek. So we should remember that. We've already talked about gamma. I'm not going to talk about it, but it's a second order Greek. The other second order Greek that a lot of people use is charm. Charm is delta decay. Think about decay, or what we talked about as theta. Theta is the measure of how much the option should change over a 24-hour period of time, theoretically. Charm is a measure of how much your option's delta should change over that same 24-hour period of time. If you consider the fact that the delta of the option is intrinsically tied to its value, which it is by some function, when you change its value, you inherently change also its delta. And so what charm measures is how much that delta moves if you keep everything else constant and fast forward the clock by 24 hours. It's the delta decay of an option. The other thing is VAMA. VAMA is a pretty far down the list second order Greek. It's called vega convexity. It is really how much the vega of an option is going to change when you move the implied vol up or down 1%. If you consider valuation as intrinsically tied to vega, which it is in some way, shape, or form by some function, as you move that value of the option up and down, its inherent amount of vega is going to change based on how much intrinsic and extrinsic value it has in it. And so VAMA is the measure of how much that vega changes when you move implied vol. It's a second order Greek. It measures the difference between vega at one point in vol and a different point in vol. So those are two of the kind of like second order Greeks that we'll talk about really quickly. March 8th is delta, gamma, and theta as far as the webinars are concerned. And March 15th will be vega, rho, and all the second order Greeks. Both of those happen at 3:30 Central Time, and you can check them out on optionseducation.org. Those webinars.
Well, excellent, Matt. Thank you so much. I want to thank you certainly for your time, and thank you for your information today. I also want to thank our listeners out there for tuning into this session, as well as all of our other Wide World of Options sessions. Before we sign off, I want to invite you to register for Matt's two upcoming events, which he just discussed. March 8th and March 15th. And he's going to be taking a closer look at Greeks, as he had mentioned. One session is going to be Delta and Delta Gamma Theta, and the next session will be Vega, Rho, and those second order Greeks. You can register on our OIC website, optionseducation.org, and you can attend the live presentation, or your registration also will enable you to view that event on demand. As always, please feel free to send us your questions via email at options@theocc.com, or you can live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very, very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.